What I said was to put the stock market back into historical mean ratio as far as total market cap of equities to GDP. Just to go back to an historical mean, it would need to drop 40 to 50%. Okay, that's what I said. So does that mean that I'm calling for the correction, the stocks to crash? No, I didn't say that. And as a matter of fact, I'm still not net short in my portfolio, and I haven't been since the early part of 2023. So I got net short in 22, and then I closed out my net short position in Q1 of 23. So I'm not a stop clock. I'm not always calling for a recession, and I'm not always calling you to short the stock market. For home prices to correct, they need to drop 40% just to bring that historical mean metric in line, the home price to income ratio. That's what they need to come back to normal. Now, what can happen is that the GDP can increase or incomes can increase and home prices can stay where they are and stock prices can stay where they are. I doubt that's never happened before. So let's just look at some facts here. The fact is that I think the S&P off of its high in mid-February. So the S&P is down about 6% and change. The NASDAQ's down 15% off of its high. So in my view, we're starting that reconciliation process. Is it going to be linear? No, but the chaos has begun. That's clear. If you look at a lot of metrics, I have a 20-point model. A lot of them are flashing bright amber to red. Some of them are actually in the red. Two of the most important indicators, highly stochastic, have not flashed red yet. They're just now recently, within the last few days, flashing yellow, is financial conditions and credit spreads. I need to see financial conditions tighten more, and I need credit spreads to widen more than they are now before I become net short in the portfolio. That's something you don't do willy-nilly. You have to calculate it. You have to measure and map it carefully. But here's the thing. The important part is when you're managing money, if you want to be a successful money manager, is to understand the risk-reward ratio. You should ask the question, what made you get almost neutral in your portfolio? I'm net long 20% with hedges, with gold, and with anti-beta plays, and with a short and junk bonds. What made me do that when everybody else was banging pots on roofs about how great 2025 was going to be? And it's just simple calculation that the risk-reward ratio was skewed way to the negative as far as any significant increase in returns on the S&P 500. We were trading at 22 times forward earnings that predicted a 13% increase in earnings. It's a very rich multiple on earnings growth that just was unachievable. When you have labor force contracting and when you have tariffs and you're hoping to extend tax cuts at the current rate, that's the fiscal and monetary scenario. And by the way, the Fed put is on ice. The rate of inflation, which is very sticky, it's not gone anywhere near 2%. It's been north of 2% for 4 years. The Fed cannot, they're handcuffed. They cannot proactively cut interest rates at this moment. There's no Fed put. There's no Trump put anymore because the zeitgeist was that Donald Trump was going to come in and he's going to measure his success on his administration by the stock market. And he told you, no, I don't care about the stock market. To his credit, to have the courage to say the U.S. has some intrinsic issues that have to be fixed. Number one, we can't have massive trade deficits anymore. We can't have a hollowed out middle class. We have to bring manufacturing back to the United States. It's a matter of national security. For now, he has the courage through the use of tariffs. And I'm not saying that's the best method. Implementation of these tariffs could have been improved, can be improved still, but there's just no way you were going to get nominal GDP growth anywhere near double digits. At best, I get nominal GDP growth around 5%. And that means that the market should be trading around $5,100. The S&P 500, around $5,100. If you say there's no recession, we have a moderate growth in earnings, and earnings growth tends to correlate highly with nominal GDP growth, and you slap a very rich 20 multiple on that, you get 5,100 on the S&P 500. And so I said the risk-reward ratio, if you look at price to sales, that was at 3, total market cap of equities, that was 200% to GDP. If you look at risk premiums that were negative, that was the calculation, just to pull in your horns a little significantly. And that's exactly what I did, and it's paying off. I want to dispel one rumor that I keep hearing people talk about is that Trump is trying to bring interest rates down by causing a recession. That would be the dumbest thing that any individual has ever done. I mean, what call a Pyrrhic victory? Well, hey, I got rates down, but unemployment rates are skyrocketing and the very fragile housing market is tanking, and so is the stock market. So, I mean, how's that going to be a victory lap? So that's ridiculous. Like I said, the implementation of these tariffs is terrible. What I think he should do, and what I was hoping he was going to do, is just say, yeah, okay, April 2nd, we're going to have reciprocal tariffs. And then you give yourself a month or whatever it was, maybe a little bit more, to negotiate with all these countries on an individual basis. Say, here's our trade deficit with you. A trade deficit is not supposed to be standard procedure here. You need to buy more of our stuff. What do we need to do? What do you promise to do to make that right? and you have tariffs on our autos or tariffs on our steel or tariffs on our crops, whatever, and they need to be commensurate with the tariffs that we have on you. But hopefully the tariffs will be zero. Of course, there's other factors. There's subsidies that governments have. So these have to be worked out, but you have about 4 or 6 weeks to do it. What's happening is, the tariffs were going on Mexico and Canada at 25%. And then 24 hours later, the stock market fell apart. And so the tariffs were postponed for 3 months. And then there's carve outs and everybody wants to carve out for their industry. And you just have no idea what's going on. So I think the most important thing is businesses need some kind of confidence and surety about what these tariffs will be. And I'm hoping they'll be as low as possible because tariffs are taxes and that creates friction in the free market. What was at play here is that the stock market had no room for error. It was the most fully valued stock market in history. Back in the 80s and 90s, total market cap of equities to GDP was well south of 100%. It was 104% in 2007, and it was 140% in the NASDAQ bubble in March of 2000. So it had no business being at 210% total market cap of equities to GDP. There was no room for error. And the error has arrived. I did not predict that the market was going to fall. What I did predict, what I acted upon, was that there was no or little room for upside. And you were much better off being in treasury bonds than you were in the risks associated with stocks. And that is proven to be 100% correct and looks more so on a daily basis. And if I see financial conditions tighten, and if I see credit spreads, these various spreads that I look at, if I see them starting to widen that to a point that triggers my model to let me know when the probability of a recession is increasing, I will eschew some more longs and I will take a position in more of a short posture in my portfolio. If you look at what's happening with like Melania coin and Dogecoin, the high beta plays are getting wiped out. The Teslas of the world, the Nvidias of the world, the Mag 7s of the world. And there's been a rotation out of the high beta stocks into the equal weight and to the low volatility sectors. There's no doubt about that. Finally, has been a ballast in your portfolio with owning bonds. Now, I don't think this move is going to, especially on the long end of the curve, has a lot of room to run simply because our deficits are just incredible. A $2 trillion deficit. That deficit is going to explode to the upside if we have, and we do have an economic slowdown. In February of this year, the Atlanta Fed had Q1 GDP at close to 4%, and now it's minus 2.4%. That's a plunge in growth. And here's what the main takeaway from that is. If you were of the belief that somehow you were going to get 13% earnings growth on the S&P 500, and by the way, US global S&P manufacturing and service composite index show a similar slowdown in the economy. It's not just the Atlanta Fed. The ISM also looks like is weakening in the wrong direction. And a lot of these sentiment surveys in the wrong direction. National Federation of Independent Businesses showed a huge decline in consumer sentiment, and how these small businesses are hiring and what's affecting their businesses is not good right now. So you're not going to get 13% earnings growth, especially when there's no tax cut of any significance on the horizon. Now, 2018 cut was from 35% to 21%. That's a pretty big boost to corporate America. There's no such boost coming. I mean, you're probably going to get the votes. I'm very confident that you get the votes to extend the Tax Cuts and Jobs Act under Donald Trump that was effective in 2018. But that's just keeping the current rate. So you're not going to get a massive tax cut. You have the closing of the border, you have deportations, you have tariffs, which are tax increases. You're going to need tariffs to offset the way they score it in DC, to offset the ability for Congress to avert a $4 trillion increase in taxes because the Trump tax cuts expire. They sunset in December of this year. So how are you going to get 13% earnings growth? It's not going to happen. The best case scenario is 5% that I can come up with. And if that's the case, then the stock market is still very overvalued, and it's not going to become even mildly interesting to me until we get 5,100 on the S&P 500, or we get a trenchant change in the rhetoric around tariffs. Well, there's only two places growth comes from. It comes from an increase in the labor force, and that's actually going in reverse. And then you have a hope of a massive spike in productivity. That's the other half of GDP. Maybe AI can provide that for you. I don't know. The short term on the other side of the balance sheet there, if AI causes a massive surge in productivity, it's going to lead to layoffs in a big way. That's the other side of that productivity. At least short term, layoffs have to spike to have productivity rise. So that's very economically disruptive. I predicted the rise of UBI, and I'm not a conspiracy theorist. I'm just looking at facts. Universal basic income, it's a form of helicopter money. The government just prints money and hands out checks to people to lay fallow and do nothing. Is there some kind of grand scheme? Is that where, the dumbing down of Americans, the wiping out of our middle class? I don't think Trump's going to lay down and let that happen without a fight. But you could see that inexorable trend towards, hey, I'm just living off the government. I don't have the skill set to be gainfully employed, and I'm going to just wait for my check to arrive. It could be a byproduct of AI. I'm not saying it's part of a grand scheme, but certainly the groundwork of helicopter money and central bank digital currency, that's all part of the universal basic income, where people are just home. Maybe they work 2 or 3 days a week at a resort somewhere, and it's part of the end of American middle class.